Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this episode, I want to get into the credit market a little bit. We've seen some cracks, and while we've talked about it on and off here and there, I wanted to go just a little bit deeper on this subject. Really given a number of things that are going on. And so let's jump into it a little bit. I guess, what I would say is we take a step back in recent periods. We've seen essentially sort of events that shake the credit market. So for example, auto parts supplier First Brands and lender Tricolor basically had bankruptcies. And those events really reveals the potential for vulnerabilities in the fast-growing private credits market, right? So this is an area that's grown a lot. And, what the analogy that people have talked about, which maybe I've mentioned before, is worries about quote-unquote credit cockroaches, meaning, hey, if there's one, there might be more out there. So what's the backdrop to this? Well, by some measure, the private credit environment or market has grown to $1.7 trillion. And this is obviously supported by, on one hand, investor demand for higher yield, but also then on the borrower side, a desire for flexibility that they can accomplish outside of more traditional sources like banks, for example. And, when we look at this part of the market, it's basically over 90% of those assets that are illiquid, and they're loans to middle market companies where the maturity on those loans are beyond 5 years more often than not. And so because these are illiquid, because the maturity is out there a little bit, that creates the idea that because they're illiquid, if investors want out, there might be some trouble. And so when you couple that with the idea that some of this capital has been raised in what are really semi-liquid vehicles, meaning that there are quarterly withdrawals. There's the potential for a mismatch between essentially the need for liquidity and the desire for redemptions. Now, in normal calm periods, that typically doesn't happen, but it's a good thing to remember that if we see deepening trouble in the credit market, one area of focus will be the liquidity, especially on those semi-liquid offerings. Now, when we look beyond the private credit market, we look at the consumer, for example, we're seeing a little bit of a bump up in credit card delinquencies. These happen to be reported by the New York Fed. So the 90-plus day delinquency past due has reached over 12%. It's the highest level since 2011. And then auto loan delinquencies are at 5%, and student loan delinquencies have moved up to over 10% as of the second quarter at least. And so in the consumer credit space, again, I think overall, even like private credit, everything's pretty calm and reasonable right now, but we're just seeing these little glimpses of a little bit more trouble. And so a final area I'll mention is below investment grade bonds. These are sometimes called high yield bonds, sometimes actually called junk bonds. So they're higher risk bonds, right? And so that's another area that people focus on. And one way to gauge what's going on is default rates. And so we've seen just a modest nudge up of default rates in high yield by one source to 3.5%. And that's up from about 2% a year ago. So these are still, by historic standards, pretty low numbers, but it's still sort of the directional thing that has people's attention. Anyway, to sort of close it out here, I wanted to talk about a couple other things. The first is this idea of sort of a big wave of debt maturities. Some people are calling it a wall or a cliff, but think of it as $3.6 trillion in rated corporate debt globally that's scheduled to mature in 2028. And most of that will get refinanced. It'll get refinanced at higher rates. And so the cost of that debt will be borne by the borrowers, right? And so that's just something that, again, everybody has their eye on. No trouble, but we're going to keep a close eye on it. And then this is against the backdrop of not necessarily a recession. Right now, I think the surveys say that economists are estimating about a 30% chance of a recession over the next 12 months. That's in line with the long-term average. But when it comes to economic growth, we're seeing a slowdown. There's an estimate out there, consensus estimate of 1.1% for U.S. GDP annualized in the fourth quarter, moving back up to about 1.5% for first quarter 2026. And so, again, I would just sort of reinforce no significant trouble, but a little bit of a slowdown, and that kind of combined with what we're seeing in the credit markets is sort of like we have to keep a pretty close eye on what's going on as we look forward. And honestly, the only other thing I'll mention, which we've talked about a bit recently, is that there's a little bit of a linkage between the credit market and the equity market, meaning when things get stressed in the equity market, they often are also stressed in the credit market and vice versa. And we have talked about at least a possibility of a pullback in the equity market. So again, all in all, we think things are reasonably calm, but a few cracks here and there. Listen, that's what we wanted to cover in this episode. Really appreciate you taking the time to check us out, and we'll look forward to talking to you again next time. Thank you.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.